Welcome to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.
Hello and welcome everybody. Ahalya here, keeping you company on a brand new episode of Smart Investing, brought to you by PGIM India Mutual Fund. Now, as always, I'm of course going to hand it over to our experts, Ravi and Lisa, to take you through another insightful topic that can really help you get started and on the right track in your investing journey. But before that, let me preface today's theme with a little story, shall I? So I recently accompanied my parents to the bank because they decided to put a lot of their corpus, right, that they have accumulated over the years into mutual funds. Finally. And as someone who really enjoys personal finance and investing, I was sat there thinking, why did it take you so long, Mom and Dad? And then I found out that they had all kinds of preconceived notions about investing in mutual funds that, our fund managers finally busted for them. And that's exactly what's going to happen on today's episode. Before we put our hard-earned money into a product, I think it's only natural that all of us have these ideas and beliefs about what can and cannot happen. And more often than not, they all turn out to be myths. So stay tuned, get your notepads out and pay close attention because along with busting these myths, I think Ravi and Lisa are also going to give us some very, very valuable insights into the world of mutual funds that'll help you understand the foundational concepts of investing into mutual funds a lot better. Let's go.
Thanks, Ahalya. Hi, everyone, and welcome to Smart Investing. Now, today we are diving into a topic that every mutual fund investor needs to hear about. These are the myths surrounding mutual funds. I'll be very honest with you. When I started my career in the mutual fund industry, I believed a lot of the myths too. Things like 10 rupee NAV is cheaper or you'll lose money permanently in equity. These misconceptions are everywhere and often they scare people away from making the right investment choices. So today we are going to bust these myths. Welcome, Lisa.
Hi, Ravi. How are you?
I'm good, thank you. So, Lisa, let me start off with the first question. Many of my friends and acquaintances ask me this, this is the top performing mutual fund in the last 1 year. Should I invest in it? So, is it a good filter to start with?
Yeah, Ravi. So, so true. I think this is one of the biggest myths, really. Mutual fund schemes literally hang on this hook. However, last 1 year return is definitely not critical for choosing equity-oriented funds. Remember, equity is a long-term asset, right? We are talking 5, 10, 15 years. Then why are we picking the fund based on a short-term 1 year return? In case of funds which invest entirely or even partially in equity, it is important instead to assess long-term rolling returns. And we have discussed this, right, in the previous episodes. It's also important to look for consistency of return and the ability of a fund to outperform its benchmark consistently. Now, if you were to talk about fixed income funds, 1 year return, although it's not critical, is a better guide. But again, just settling on that is not going to give you any pointers. You need to analyze the consistency with which a fund is able to maintain the outperformance against its benchmark. It's just that, 1 year return is understood very intuitively. You see what the fund did in the recent year and you feel that is what you can expect going forward. But be careful of falling for this myth and also remember that past performance cannot be an indication for future returns.
Yes, you're right. And the last 1 year return could be misleading because if you're in a bull run, the returns could look very attractive, but it may not sustain in the future. There's another commonly held belief that, the 10 rupee NAV is very cheap. So many people are attracted to new fund offers. So what's your thought on this?
Clearly, this is not true. Yeah. So when we consider stock prices, a correction means a fall in price. All else remaining the same, a price correction is not saying that, now it's cheaper. And this should also hold for a portfolio of stocks, which is what a mutual fund is, right? A lower NAV owing to a market correction is a lower value. But when you compare a rupees 10 NAV of a new fund with a rupees 100 NAV of an existing fund, this logic of, the 10 rupees is cheaper than 100, it doesn't hold. Let me explain, right? In both cases, you are investing in a portfolio of stocks. In a new fund offer, money from several investors is pooled into an account and the stocks are bought. The portfolio value is then divided up among all the investors with each unit priced at rupees 10. You own the portfolio in the proportion of the number of units you have bought versus the total number of units which have been created. Your return is measured from that point on and depends on the performance of the underlying portfolio. This logic holds true for a fund where you pay rupees 100 per unit as well. If both portfolios are the same and performance is the same, your return will be the same, regardless of the per unit NAV. So a 10% return on a 10 rupee NAV will take it up to rupees 11, and it will take a 100 rupee NAV up to rupees 110. But the gain is 10%, right? The absolute value of the NAV has no relevance for the performance of the scheme being, where you have invested, because it is simply a mathematical division of the portfolio value with the total outstanding number of units. As more new investors are added, fresh units are created, and the portfolio also expands. So what you have to focus on is not the absolute value of the NAV, but on the return.
Yes, you're right. In fact, it's the returns that a fund generates that matters. And in fact, a new fund offer will always have 10 rupees NAV, whereas a old fund which has completed say 10 years, 15 years or even 20 years, that will always have a higher NAV. So one should always look at, I think, the risk profile of the fund and the investment strategy while choosing a fund rather than looking at NAV. Now, a lot of people, they say that, I don't have money to, start investing in mutual funds. So how much money do you really need to start investing in mutual funds?
So this is something which has improved quite substantially over the years because of, technology, etc. You can now start investing with as little as rupees 500 or rupees 1000 if you want to invest in a mutual fund scheme. Depending on the NAV of the scheme, units will be allotted to you, right? Again, despite the small amount, you will get the benefit of the entire return earned by the portfolio you are investing in. And even though with a rupees 10 NAV, you get more units than say a fund which has rupees 200 as its NAV, the gain is the same. I'm repeating this, but it's important. So a 10% gain on a 10,000 investment will be 1,000 rupees regardless of whether you have 1,000 units or 50 units. And if you can begin with as little as 500 or 1,000, you can build it up to a 10,000 rupee investment. And you don't have to start small. You can start with investing large lump sums as well.
Yes, it's a bit technical, and I think if people just Google and learn more about it, then I think definitely they can understand this concept, better. I was just looking at a newspaper article and it said that, 224 lakh crore rupees is invested in scheduled commercial bank deposits, which are your bank deposits as of November 2024. So, of course, I think the fixed returns that banks offer is the main allure for which, investors are investing in bank fixed deposits. Now, when it comes to mutual funds, the returns are not guaranteed. So there's always this fear that they'll lose money. So what do you have to say about the risk aspect of mutual funds?
Yeah, so obviously it's a different product with a different kind of risk return profile. However, as you know, Ravi, mutual fund returns are market linked, right? What that means is that they follow the trajectory of the market. Now, for decades, Indian investors have been used to fixed deposits and also to real estate investments. Fixed deposits have the word fixed in the name. So the return is defined beforehand, which gives investors a lot more kind of feeling of certainty. In case of mutual funds, there is a daily change in price because they are market linked and because stocks and bonds are listed and there are daily trades. But just because return is not assured or guaranteed doesn't mean that you will lose money. It just means that the daily price will change and over time the asset delivers returns based on its own characteristics, right? Again, let me explain. An equity mutual fund is a portfolio of stocks. if the quality of that portfolio is good and the underlying stock prices do well over time, the mutual fund scheme itself will do well. In case of a debt fund which holds bonds, there is price fluctuation there as well, but over time the return kind of matches the aggregate yield, which comes to a large extent from the defined interest payout from these underlying bonds. Hence, debt funds are considered to be a lower risk than equity because of the potential return, which can be estimated with greater certainty. However, in both cases, there will be, daily change in the NAV. Now, coming back to the myth, mutual fund returns are not assured only because the value is linked to the current price of the underlying, and that changes daily. But the lack of guarantee or assurance does not say anything about the ability of the fund portfolio to deliver future returns. That's based on the quality of the portfolio, which is what investors should be looking at.
Yes, and it's good you brought up debt funds too in the discussion, because mutual funds typically are associated with investing in equity funds, and debt funds are not so popular among retail investors. So you can also invest in, I think, debt funds and gold, silver, and also other asset classes, right?
Right. Ravi, this myth that mutual funds are associated with equity, it exists a lot with retail individual investors. Actually, if you look at the data, if you consider the breakup of assets in the mutual fund industry, there is, I think, slightly over 16 lakh crore invested in open-ended debt funds as of the recent month end. But bulk of this comes from corporates and institutions. Why do they invest so much in debt funds? For capital safety. Individual investors on the whole still prefer bank deposits, but debt funds can also perform the same function of low risk, stable returns that deposits provide. What's more, you can make SIPs in your debt funds as well. This can be very useful in creating your, emergency fund kind of allocation or funding a short-term goal. Plus, there is a good variety in debt funds, so you can pick the level of risk that suits you. There are also gilt funds which invest only in long-term government securities. These are very useful again in creating your long-term debt allocation. Lastly, just for the benefit of our investors or people listening in, there are credit portfolios for those who want to take some added risk in debt investments. So honestly, there is a lot available for investors in debt funds, and you can pick a fund for any goal really. So in that sense, mutual funds are good for more than just long-term wealth creation, which of course needs equity allocation.
Yes, you're right. And the mutual fund industry offers a lot of categories for investors to meet any of their goals, be it short-term, medium-term, or long-term. So you have debt funds, equity funds, hybrid funds, international funds, REITs, and so on. So another requirement of many mutual fund investors, and especially those who are senior citizens, could be, cash flow. So they might be attracted with the dividends that are offered by mutual funds, which are of course now called income distribution cum capital withdrawal. So basically, SEBI has changed this nomenclature from dividend to IDCW. So I think it's done to better indicate what the term indicates. So can you explain more to our readers about this dividend concept?
Yeah, sure, Ravi. So unlike stocks where dividend is additional income because it is paid to shareholders from the profits of the business of the underlying company and declared every year, in case of mutual funds, dividends are simply a redistribution of the portfolio gains. It was a way earlier for investors to take out the gains from the fund periodically. Maybe you needed the money for something, but over time, it's better understood now that money left in the portfolio is a greater use for the funds as compounding occurs for the gains as well. And that's how you generate a higher return over time and create long-term wealth. If you keep taking money out, the long-term return will suffer too, right? So hence, dividends in a mutual fund were a misnomer, and which is why, as you were saying, they are now called income distribution cum capital withdrawal instead of terming them as dividends.
Yes, I think if you want to gain from the compounding effect, it's better to go for growth plans. And if you do wish to get a cash flow, and I think SWP, which is systematic withdrawal plan, would be a better and tax efficient option for investors. Now, when we look at the whole personal finance space, fixed deposits have a particular tenure, like 6 months, 1 year, 3 years, 5 years. Insurance policy also have a tenure. Now, when it comes to mutual funds, there is no particular tenure. So, how should people approach this? Because a lot of people ask me, what should be my time horizon in, say, equity funds. So, I just tell them, you can keep invested in the fund as long as you don't require the fund. So, what's your say on this?
Yeah, so even I've been asked that, will I get my funds back at maturity regarding mutual fund investments? So yes, people think that there is a fixed period after which your mutual fund will mature and you will get the money back. But that's not how this works. You can remain invested for as long as you want. In case of growth assets like equity, longer you are invested, the better it is. If you are investing in an open-ended mutual fund, equity or debt, whatever, there is no need to withdraw the amount after any kind of defined period. You can redeem when you need it, and the advantage is that you can redeem partially as well. So you don't have to take everything out. You can just take out an amount that you need at that time. Also, that means you pay tax only on the gains for the amount that you are withdrawing. So it does create an efficiency in that sense. Just take what you need, you can defer taxes, and you can leave the rest invested. So the fact that there's no defined maturity for open-ended mutual funds, in case which really covers 90% of the schemes out there, it's beneficial in many ways, and it helps for people to understand that when they begin their mutual fund investment journey.
Yes, the longer you hold, I think the better it is, especially for your long-term goals. Thanks, Lisa. And let's clear up the biggest myth that I often come across, that SIP and mutual funds is not separate, because people say that I've done SIP, I'm not investing in mutual funds, which SIP is just a facility to invest in mutual funds, just like an RD, recurring deposits. You invest in mutual funds through SIP. So SIP itself is not a scheme, right, Lisa?
Yeah, absolutely, Ravi. Many people I meet say I'm investing in SIPs, not mutual funds, whereas it's really the same thing. SIP is a facility offered by asset managers, and you can invest in mutual fund schemes through SIPs.
Great. So I think we have covered a lot of ground today, and let me sum up the 5 key myths associated with mutual funds. So the first one is the past performance, especially 1 year. It's not the only filter to choose mutual funds. Look at long-term rolling returns and how the fund has performed during different market cycles. The second myth, IDCW or dividend payout, reduces your NAV. So it's not an income which you get over and above the gains you get on your investment. So IDCW payout are taxed at your income slab, so it is better to opt for systematic withdrawal plans. The third myth, do not equate the NAV of a mutual fund with the price of a stock. Investing in 10 rupee NAV does not really give you an advantage versus a fund having an NAV of 100 or 500. So in fact, it's the return that your underlying fund generates that matters the most. So you should look at the fund strategy and if it really fits into your risk profile. And the fourth myth, SIP is not an investment in itself. It's a facility to invest in a mutual fund, just like your bank recurring deposit facility. The fifth myth, mutual funds do not offer guaranteed returns, but that doesn't mean it's a permanent loss of capital unless you redeem it. The returns can be volatile, of course, in the near term due to market fluctuations, but it's not a permanent loss under exceptional circumstances like a default in a debt scheme. I think with that, we come to the end of this interesting episode, and I'm sure there'll be many more myths associated with investing in general and mutual funds, and we hope that we will debunk them in our future episodes. Thank you, Lisa, once again, and we'll catch you in the next episode soon.
Thanks, Ravi. Lovely sharing thoughts and discussing this. See you in the next episode.
What did I say? Insightful as well as myth busting, right? That's a perfect combination, a classic combination, actually. Thank you for tuning in to this episode of Smart Investing by PGIM India Mutual Fund. Now, as someone who loves personal finance and investing, I myself learned a lot through today's episode. So spread the word, share this episode with everybody. We'd love to hear your feedback as well. And we'll be back with another important episode that can help support you in your journey to financial freedom. Stay safe, stay happy, and of course, stay investing. Adios.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You are listening to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.